Federal Reserve recently raised interest rates by another 0.5%, and these rising rates are likely going to continue climbing. Coast Live co-host Chandler Nunnally spoke with our financial expert Carl Carlson, CEO and founder of Carlson Financial, to hear some of his thoughts about bonds.
Really be careful if you have bonds in your portfolio, and most people do. So what happens is if you owned an ETF, an exchange traded fund that had 10 to 20-year US Treasuries in it. So those are supposed to be, you're owning that for safety, 10 to 20-year US Treasuries. And if you owned that about 2.5 years ago, today the value of your investment in that ETF is down about 25% and maybe even a little more. So loss of 25% on your US Treasuries. Now, the US Treasuries didn't go bad, but the rate that the Fed is charging is now increasing. So whenever interest rates increase, the value of bonds decreases, and you can't just look at your bonds, US Treasuries, well, they're safe, they're US Treasuries, because that is a huge loss.
Yeah, Carl, can you talk a little bit more about how bonds and interest rates tend to have that inverse relationship?
Yeah, so over the last 30 to 40 years, interest rates have been declining. So when interest rates go down, the value of bonds goes up. And over the last 40 years, that's been awesome. So as interest rates have been going down, everyone's bonds have been pretty steadily increasing in value. Helps offset the stock market when the market's going down. Those bonds are doing well. And but when the opposite happens, when interest rates start going up, which is what is happening now, when interest rates start going up, then the value of the bonds start going down. So now we're seeing, folks, your portfolio, when the stock market's going down and your bonds are going down too, there's not that offsetting effect. So you really need to get yourself in a position where you're not holding a lot of bonds, and especially long-term bonds, in your portfolios.
What would you buy instead? Because a lot of us still need something like a safety that's not tied directly to our stock market investments.
The one that I think may be the best for safety and a potential upside is the fixed indexed annuity. So people should probably start studying that product a little bit. On that one, you cannot lose money. If the market goes down, you're not losing money. You're only not getting an interest credit. But if the market goes up and it's indexed to something in the stock market like the S&P 500, then you get the upside. They usually limit it. Maybe you get half of the upside in the S&P 500, but you have no downside. So that one gives you safety, nice safety, and then a potential nice upside on the rate of return.